Welcome to the Crop Insurance Podcast, the podcast where we dive deep into the world of crop insurance. I'm your host, Mike Rydell, a third-generation crop insurance agent, and I'm thrilled to have you join me on this educational journey. At our family-owned and operated business, we've been providing crop insurance expertise for generations. Our goal here is simple, to educate our listeners. Crop insurance can be complex and overwhelming, but I believe that understanding it is crucial for every farmer. So whether you're a seasoned farmer looking to stay updated or a newcomer seeking guidance, this podcast is for you. Welcome to today's podcast, brought to you by Crop West Insurance Incorporated, your agent-friendly crop insurance group. Calling all crop insurance agents. Looking to level up your agency and boost your bottom line? Crop West Insurance has the solution you've been searching for. With their proven track record of success and a range of benefits, including increased commissions, specialized training, and access to exclusive resources, they are committed to helping you reach new heights of success. Join their community of agents today and let Crop West Insurance be your driving force in the crop insurance industry. For more information, please head on over to their website at cropwestinsurance.com. Crop West Insurance Incorporated is an equal opportunity provider and employer. Welcome to the Crop Insurance Podcast. I'm your host, Mike Rydell. Today's episode, we're launching into the Whole Farm Revenue Protection Part 2 episode in our Whole Farm Revenue Protection series. So if you haven't already listened to Part 1, make sure you go back, as we're going to add on to some of the topics we discussed in the previous episode to help you build your knowledge on what whole farm revenue is all about and how it can help your operation. Let's jump right in. As we discussed in our previous episode, we mentioned there would be forks in the road along the way or along the happy path to get you from learning about whole farm revenue protection to getting a policy in place. One of the first forks in the road, as we discussed, is that you have to have 5 years of tax history under the same entity in the form of Schedule Fs or substitutions of Schedule Fs. Now, you don't always have to have 5 years. So if you are a new producer or you are qualified for a veteran producer, you actually only need 4 years of previous history. Because again, just like in the traditional 5-year history, the year that was just preceding the current fiscal year, the current calendar year, depending on how your setup is, that's the lag year. So you would need 3 years previous to that if you qualified under new producer or veteran farmer. Now, when it comes to micro farms, we'll discuss that in Part 3 of our podcast series on whole farm revenue protection. And again, like we just mentioned, if you don't have Schedule Fs, how does that work? Well, there are substitute Schedule Fs that you can fill out with your tax professional and some guidance from the crop insurance industry to get those set up, because that is what you're going to use to determine what your coverage is for your policy. Now, once you have those Schedule Fs put together and you're looking at your policy, we mentioned in order to qualify for the 80 or 85% coverage level, you would need a minimum of 3 qualifying commodities. So what is a qualifying commodity? The first place you'd want to look is in your county actuarials to determine if the commodity that you are growing is listed in order to qualify as a qualifying commodity under the Whole Farm Revenue Protection Program. Now, let's just assume that each of these different commodities are approved and in your county actuarials. The next step is to do the math to help determine if your commodity meets the minimum standard in terms of how much revenue it's bringing in percentage-wise to your overall revenue. The way to figure that out is you take the number of commodities you have. So let's say you have 2 commodities. So 1 commodity out of 2 is 50%. If you have 3 commodities, it'd be 1 out of 3 commodities, which would be a third. If you had 4 commodities, it'd be 1 out of 4, which would be 25% or a quarter. And you take that figure and you multiply it times 0.333. So if you take 50% times a third, or 50% times 0.333, you would end up with 16.67%. So if your qualifying commodity contributed to 16.67% or more in your overall revenue, it would count as a qualifying commodity. And so again, if you had 3 commodities, you would take 1 out of 3, or a third, times that 0.333, you would end up with 11.1%. So that'd be the minimum amount of revenue required for each commodity in order to count as a qualifying commodity. Now again, the reason this is important is in order to get to that 80 and 85% coverage level, you have to have a minimum of 3 qualified commodities. So if you're primarily a dryland wheat grower and you have 4,000 acres of winter wheat and you have 5 acres of canola, that's not going to count as a qualifying commodity because it's not going to meet the standards when it comes to the revenue to count. So now that you've determined your qualifying commodities, you've elected your coverage level, you've averaged your 5 years or 4 years of Schedule Fs to determine what your approved revenue is, you'll have to remember that your insured revenue is the lesser of your approved revenue or your expected revenue. Now, when looking at your expected revenue, what we're going to do is a good place to start would be your federal crop insurance policy if you have one. So we can look at your different crops that you're growing, your history or your approved yields to help determine how much potential is in the field. We can use that underlying federal crop insurance policy projected prices to help determine what the value is. If you have any contracts, so if you're a malt barley grower and you have a malt contract, you can use that. And what they're trying to do is see how much potential value you have in the field based on what you've seeded or what you have out in your operation and compare that expected revenue towards your approved revenue. And whichever one's less is what you're going to multiply times your coverage level in order to get your insured revenue. And the reason they do this, it's fairly straightforward. It's so somebody doesn't use all their big history to come up with a high insured revenue and then only seed half their farm knowing they're going to have a loss. I don't know anybody that would do that, but that's why they do it. That's why it's the lesser of. So you could seed half your farm, but you would be using your expected revenue worksheet that you fill out to come up with your insured revenue. So your guarantee would be much less than if using your approved revenue or your average of your histories on your Schedule Fs. Now, we just mentioned your underlying federal crop insurance policy, or your underlying FCIC, your multi-peril crop insurance, your livestock risk protection policy, etc. Under whole farm revenue protection, the default setup is that your underlying FCIC policy is primary. And as a result of it being primary, you get a significant premium subsidy or a premium reduction as a result. Now, the reason you do that, or the reason you get that premium subsidy or that premium reduction, is because any losses that you would have payable under your FCIC policies would count against you when it comes to a loss under whole farm revenue protection. Or in other words, any of that indemnity payments would count as revenue to count, which thereby would reduce your potential loss payment. So that's why you get that premium reduction or subsidy. Now, you can elect to have your whole farm revenue protection policy as primary, or in other words, not elect to keep your underlying FCIC policy as primary. And if you do that, any sort of loss payments you have doesn't count against you or doesn't count as revenue to count up into your deductible limits. And as a result of that, you don't get that premium subsidy or reduction because now you're opening yourself up to potentially collect a larger loss if you had a federal crop insurance loss. So you really do have to play with the math to see if it works. Now, when we say up to your revenue or up to your deductible, Let's say that you are a $1 million revenue producer. You're signed up at the 85% coverage level. And let's just assume that your expected revenue works out where the $1 million is the correct number, your approved revenue you're going to use. And so if you're at the 85% coverage level, you would have a guarantee of $850,000. Now, your deductible, quote unquote, is the $150,000 gap between your average and what your guarantee is. So if you had a federal crop insurance loss, you would be able to withhold or not count up to $150,000 in losses in this scenario before it would start counting against you in revenue to count. Now, again, you're going to pay a premium for that ability by not keeping it primary when you set up your whole farm revenue protection policy. You definitely want to play with the math on that to determine how that looks. Depending on what kind of crops you grow, it might make more sense based on what your whole farm revenue protection premium might end up being by not keeping your FCIC policies as default. But that's something you definitely want to walk through your crop insurance agent with, as it can get complicated in a hurry. As we mentioned in our previous episode, when you do report your revenue, you're going to report it in the same manner in which you prepared your Schedule Fs, so that you are comparing apples to apples, so to speak, when looking at your revenue guarantees and your potential losses in the field. Always remember that it will be the lesser of your approved revenue and your expected revenue times your coverage level to get to your insured revenue when comparing it towards your revenue to count. And in regards to loss situations and how that whole process looks, we will be discussing that in a later episode in our Whole Farm Revenue Protection series. Now that you've signed up for the Whole Farm Revenue Protection policy, you've submitted your Schedule Fs, you've gotten your average, you've looked at your expected revenue, you've determined if you're going to keep the FCIC underlying policies as primary or not, you're now ready to go through with your policy year. Now, throughout your policy year, you will submit an updated expected revenue worksheet in order to help determine if, in fact, that expected revenue is still greater than or lesser than your approved revenue, because you may not seed the spring crops you intended to seed, or something could have changed in your operation over the coming months that would change your expected revenue. But you will be filling that worksheet out a couple times throughout the policy year to make sure that we have the appropriate amount of insurance on there in regards to the lesser of your expected revenue or approved revenue when determining your insured revenue. Now, I know a lot of this can seem confusing when we keep mentioning expected revenue, approved revenue, and insured revenue, which is why, like all federal crop insurance policies or programs, you want to start the discussion with your crop insurance agent well ahead of time so you can make sure that you work through some of these calculations to help figure out what your insurance guarantee is going to be, what it's going to cost, so you have a good idea of what you're getting into before you sign up. That's why you do not want to wait until the last minute to look into whole farm revenue protection coverage, because it is a fairly complicated program that has a lot of moving parts when you're first setting it up. Make sure you join us in part 3 of our Whole Farm Revenue Protection series, as we will be discussing micro farm and what that looks like in comparison to whole farm revenue protection, along with discussing what potential loss situations can look like and other important pieces of the puzzle to helping you further understand whole farm revenue protection. From my family to yours, thank you very much for listening. I sincerely hope that this presentation has been instrumental in enhancing your understanding of federal crop insurance. If you find value in our podcast, we kindly encourage you to subscribe and spread the word among your friends and neighbors. To access further information, please visit our website at thecropinsurancepodcast.com, where you'll find the latest podcast episodes, articles, and exciting new features conveniently located in one place. This information is not all-inclusive and is meant to be used only as general guidelines for educational purposes. For additional information, please see crop provisions, reference the Crop Insurance Handbook or Loss Adjustment Manual, or contact your crop insurance agent. This institution is an equal opportunity provider and employer.